Good morning, students. Very good morning, everyone. How are you all? All good? Good morning, Abrakesh. Good morning, Dhanya, Karthik, Mamta, Nilay, Nisha, Pooja, Sahil, Stephen. All good? Good morning, everyone. Okay, Stephen, solutions for assignment. We'll be doing it by this weekend. So probably we'll provide you the solutions soon. You're talking of, I think, advanced capital budgeting. So that will be done very soon. Okay, and good morning, everyone. Okay, so we were into the chapter of security valuation, right, guys? Um, we have started with the equity valuation part, in which we were essentially looking for the various methods to value the equity shares. But the fundamental was it was simply present value of the future cash flows, right? So we first said, why is there a need of undertaking value, so that we would be able to identify whether the particular share is undervalued or overvalued, and then accordingly our decision can be taken with regards to buying and selling of the securities, whether we should buy the security or whether we should be selling the securities. Then we just had an overview about what all types of methods of valuation we are going to undertake. Then we understood something called as the required rate of return, internal rate of return, the discount rate, right? Then we started with the dividend-based model for equity shares. If it is for holding, if your holding period is just for 1 year, it's simply going to be the present value of the price of the share a year later, and the dividend that you're going to get after a year, right? So you just take the discounted value of the same. Then we observe that if it's a zero growth rate, then the answer comes out to be simply dividend upon KE. And if it's a constant growth rate, then that's our Gordon model, which is D1 upon KE minus G. Then if we have variable growth rate, we have covered like two-stage dividend discount model also. We know that we have yet to start with the three-stage dividend discount model, okay, which we'll do it in our today's class. So two-stage dividend discount model was basically taking into account that cash flows are going to grow at a particular rate for at a higher rate for initial certain number of years, post which the growth rate is going to stabilize at a lower rate. Because this formula that we had, it suffered from a difficulty or a problem that KE was supposed to be greater than the growth rate, right? So KE was greater than the growth rate, but that is not going to be always possible, right? KE can never be in the growth trajectory. The dividends cannot be growing at a normally high rate forever. So there has to be time where the dividend rate, the growth has to stabilize, right? And therefore we consider that there are two stages for dividend growth. One is a high growth rate, and it's a super growth rate, and then you have a normal or a stable growth rate. So what we did essentially was we got the value of the share at the end of stage one. That is at the start of the stage from where you have a stable growth rate, right? And then that value, along with the intermediate dividend values, were discounted to current value. Okay. Then we did few questions based on that. Then we looked at the earnings-based approach. One was the Gordon model, which is D1 upon K minus G, where dividend was, revisioned as EPS into 1 minus B. B was the retention. B was basically the retention ratio, right? Or I can say the retention ratio was helpful for us to calculate the growth rate. Then we also did it something around the key, the whole divided by key. Okay. Then we did a few questions. Now it's time for us to look into three-stage model. But before that, before three-stage model, we will look into another approach for valuation of equity shares, which is the cash flow approach. Of course, three-stage dividend discount model or three-stage model will be applicable to both dividend as well as cash flow model. So let's first try to essentially look at what is a cash flow based model, and then we'll look into the three-stage dividend discount model. Okay. Now, cash flow based model involves calculation of something called as free cash flow for the firm and free cash flow for the equity. Okay, so we need free cash flow for the firm and free cash flow for the equity. Let's first understand what is a free cash flow for the firm. Okay, free cash flow to firm. This is also called as FCFF, right? And after that, we are going to look at what is called as FCFE, which is free cash flow for the equity. Okay. Now, what do you mean by free cash flow for the firm? Free cash flow to the firm. So it's like if the company has earned or it has reported a profit, is that reported profit really a cash flow that has happened to the firm or the company? Yeah. If the company has earned certain amount of profit, does that mean that is the cash flow which has been earned by the company? No. Right? Because when we say cash flow, it means the bank balance of the company should increase over a period of time. Does that mean that company has earned earned so much amount of cash flows? No. So now our task is to basically convert that profit figure to a free cash flow figure. Okay, we need to convert that profit figure to a cash flow figure, which will be telling us how much is the cash flow which has been generated. Okay, so for that we need to do some sort of adjustment. Let's look at some of the methods to calculate FCFF first, and then we'll go for how to calculate the FCFE. Free cash flow for the firm is computed as first your net income. Net income is basically the profit after tax which the company has reported. Okay, so free cash flow for the firm will be your net income, which is the profit after tax which has been reported by the company. Now, since we are talking for free cash flow for the firm means, does it mean only equity shares? When I say free cash flow for the firm, am I trying to calculate cash flow for only the equity shares in this case? Because the nomenclature is free cash flow for the firm. So, what are we trying to calculate? We are trying to calculate free cash flow for equity shares or for the all the fund providers. Are we trying to calculate free cash flow for equity shares or the entire firm, or I can say all the types of fund providers? Can I say for all the types of fund providers? Right? Because we are using the word free cash flow to firm, not free cash flow to equity. So when we say free cash flow to the firm, we're talking of how much cash is being generated for all the fund providers that we have in the company. So we're taking all the investors together, be it equity shareholders, debenture holders, preference shareholders, bankers, from wherever you have got those long-term funds. We are trying to calculate what is the fund that has been generated, what is the cash flow that has been generated, out of which you will pay cash flows to those fund providers. Because if you have free cash flow from firm, then only you will be able to pay the interest, then only you'll be able to pay the designated amount of interest, the principal, the dividends, and all those cash flow which goes to the fund providers or the investors. So my idea over here is to compute the free cash flow for the firm for all the investors together. Okay. So now I need to add back. I need to subtract certain items. Before I put up the numbers, put up the names, can you tell me what all things should I add back to arrive the number of free cash flow from that of the profit after tax or net income? What all things should I add back? First, let's talk of what all things should be added back, and then we will think of what all things should be subtracted. So just think of what all things should we really add back when we want to know what is the free cash flow that we have for the investors, for all the investors of the company. Yeah. Okay. Some are saying depreciation, okay. Interest, okay. Non-cash outflows, perfect. Any loss on sale, okay. Working capital, okay. Perfect. So let me just put it in front of you. It's going to be net income plus. First thing that we are going to add back is interest expense, right? Interest expense multiplied by 1 minus t, because we want to take the after tax effect of interest. Okay. So when we want to take the after tax effect of interest, it's obviously going to be the adding back item will be after tax interest, which is interest expense into 1 minus t. Then of course we are going to add back the depreciation because it's a non-cash item. Correct? These two items are definitely going to be there. Now, in addition to this, there are two more items which will be adjusted when we are looking for free cash flow. For free cash flow for the firm, two more items needs to be considered. One is it will be either addition or subtraction of capital expenditure. Like if you are like, suppose this particular portion, net income plus interest expense into 1 minus t plus depreciation we do, this is what the cash flow has been generated. But out of that, if you have purchased a particular machinery, or let's say you have purchased a new furniture or new building or new project you're getting implemented, then that has to be done on this capital expenditure also, right? So I need to remove that part. Similarly, if you are selling any asset, okay, and you are realizing some cash flows, that cash flow is something also which is coming into us. So therefore I need to adjust the capital expenditure also, right? And of course, add or less changes net working capital, right? So that's going to be the final figure, which is changes in the non-cash net working capital. Non-cash means we are going to exclude cash from the changes in working capital. Okay, cash is not going to be counted in this case. So this is how you compute the free cash flow for the firm. So we compute the free cash flow for the firm by starting with net income. You add the interest expense, which is post-tax interest expense, adjust the capital expenditure, and adjust the non-cash net working capital. Okay, can you tell me what will be included in the non-cash net working capital? Can I say it will include your stock, changes in stock, include the changes in receivables, it will include changes in payables, right? Or it will include other advanced or prepaid expenses. So all those items are taken into account because we want to know what is the free cash flow, right? We want to know what is the free cash flow, and therefore we are just excluding the cash from this. Okay. Stephen is asking depreciation 1 minus t. No, why would you take depreciation 1 minus t? See, interest was subtracted while computing net income because it was actually going to be paid. And the idea for adding interest expense 1 minus t is we want to know what is the cash flow available to all the investors. So the payment that you're making to your debenture holders was already subtracted. So therefore, I'm adding back, taking it as after tax effect. Depreciation was never going to be paid. Depreciation was deducted while computing net income only for the tax deduction purpose. And therefore, that entire depreciation item needs to be added back. Okay, so that's the free cash flow for the firm. So the formula to get the free cash flow for the firm. This is one approach where you start with net income. There are different approaches again available when you want to compute the free cash flow. Now this was, based on net income. Similarly, we may have, free cash flow for the firm calculation based on operating income or earnings before interest and tax. So when we already have the information of, let's say, EBIT, FCFF, can you guess how are we going to calculate the FCFF? If we start with EBIT, if you're starting with earnings before interest and tax, what do you think? What will be the way to start calculate the FCFF? Yeah. This? Anyone? Suppose if we start with EBIT, if I start with EBIT, how do I get the FCFF? How do you get the FCFF, guys? Hey guys, how do we start with this? EBIT? EBIT, okay, less tax and interest, 1 minus T, okay. Well, if you start with EBIT, we first take it as earnings before interest and tax, multiply it with 1 minus tax rate to make it after tax EBIT. And then, of course, we add back the depreciation and the rest portion actually remains same. Plus or minus changes in capital expenditure, right? And then again plus or minus the changes in non-cash net working capital. Okay, so if we have to start with EBIT, this is how we are going to calculate it. Okay. Now, we may have another approach also to calculate the FCFF, which is free cash flow for the firm. Now, that approach will be obviously going to be starting with, suppose we have the information about EBITDA. So, if it is like based on EBITDA, have you heard this term EBITDA, guys? Have you heard this term EBITDA? Ever heard this term called as EBITDA? Yes. Yes, before interest, tax, depreciation, amortization. Perfect. So if you already have EBITDA, can you guess, or not guess rather, can you just think of how do we calculate the free cash flow for firm in that case? Yeah, guys, tell me. How do we start? How do we calculate the EBITDA in that case? I mean, free cash flow for the firm if we know the EBITDA figure. Yeah. How do we calculate? Okay, we start with, let's say, EBITDA. Then this is before interest, and this is also before depreciation and amortization. So I need to give the effect of tax savings due to, I need to give the effect of tax saving due to amortization, due to the depreciation and amortization, right? So of course we need to make this EBITDA figure after tax figure by multiplying it to 1 minus T. Plus we need to add back the depreciation tax saving. We need to add back the depreciation tax saving by simply multiplying it with the tax rate, because whatever depreciation you will be claiming, you're going to get a deduction on that. Right? And therefore, we say it is going to be add back depreciation into tax saving. Now, of course, the other part remains the same, which is plus or minus capital expenditure, right? And then plus or minus changes in non-cash working capital. Correct? So we can calculate this FCFF using these three approaches. There is one more approach left, which is, let's say you have access to the cash flow statement. Suppose you have access to the cash flow statement. Now, if I ask you calculate that based on cash flow statement, how do we calculate them? Which part of our cash flow statement are we going to begin with? We know how many parts does our cash flow statement have, by the way, guys? 3 parts, right? What are those parts? What are those three parts of cash flow statement? Operating, financing, and investing. Correct? Now, to calculate free cash flow for the firm, for the entire firm, we are going to start with cash flow from operations. Right? We are going to start with cash flow from operations, and of course, we will, add back, those when we have this cash flow from operations. You might have already considered that because we want to calculate it for the entire business as such. So we need to add and subtract the capital expenditure. We need to add and subtract the capital expenditure because we are trying to calculate free cash flow, cash flow for the entire firm together. So if it is for the entire firm, then of course we need to, working capital component is already adjusted in this cash flow from operations, right? Moreover, when we are looking at cash flow from operations, the interest component, would have been already considered, it would have been already excluded because that would be taken into the financing component. So the only aspect which is left out is the capital expenditure, and therefore we consider this to be, free cash flow from operations. Now, if in your free cash flow from operations, you would have accounted for, let's say, interest. If interest would have been subtracted while computing free cash flow from operations, you will have to add back the interest expense into 1 minus T, which is the after-tax interest expense. Okay, so this interest expense into 1 minus T, which is post-tax interest expense, will be added back only if while you're computing cash flow from operations, you reduce the interest. Okay, so these are the approaches by which we can compute free cash flow for the firm. So these are the ways by which we are going to calculate the cash flows which are available to the entire business as a whole, right? Now, we are really not interested in calculating something called as, only free cash flow for the firm, but rather we want to undertake the valuation of the equity shares. So are we really interested in knowing what is FCFF, or we should be really looking for something called as FCFE? Yeah, correct, guys? So what should we really be interested in calculating? Free cash flow for the firm or free cash flow for the equity? When I want to value the equity shares, are we going to look at the free cash flow to the firm or free cash flow for the equity? Yeah, tell me, guys. What should we be interested in when I want to value the equity shares? FCFE, right? So we need to calculate free cash flow for equity, correct? So how do we calculate that free cash flow for equity from free cash flow from the firm? Free cash flow for the firm. Okay. Now let me just show you simple thing. Free cash flows to equity, which is FCFE. Now, how do we compute this FCFE? Of course, we start with free cash flow for the firm if they have given us, right? And what all changes do we need to make to it? Can I say from the free cash flow to firm, I need to subtract the interest 1 minus T, which is after tax interest cost, because that will be paid out. So that needs to be subtracted. the firm, I mean, the cash flow which the firm has, from that interest will be paid out. And then, of course, from that, we are also going to pay the principal. So principal repaid, that needs to be subtracted, correct? So principal that has been repaid, that needs to be subtracted, because the cash flow which the firm is having, from that interest will be paid, from that principal we paid. Also, we need to subtract less preference. We need to add back new debt raised. So if any new loan has been raised, new funds have been raised, then that funds also comes to the business, and that equity shareholders do have the access to that funds, because they can utilize that fund for the furtherance of the business, right? So what is the free cash flow which is available for the firm needs to be adjusted to arrive at the free cash flow for equity. So you subtract the interest expense, post-tax interest, you subtract the principal repaid. When you're subtracting the principal repaid, of course, if you're raising any new debt, if you're receiving any principal, that needs to be added back. And of course, preference share needs to be deducted. Okay. Now, once we have this free cash flow for equity, or free cash flow for, let's say, the firm, and from that you derive at free cash flow for equity. Now our task is simple, to simply take the present value of the free cash flows. Okay, if I tell you that free cash flow for the equity needs to be computed afresh, because suppose we don't know what is free cash flow for the firm, then how do we go about calculating the free cash flow for equity directly from the financial statement? So simple, we say net income, correct? Net income. To that, we will add, like, FCFF is this number. So you add net income. To that, we don't take this interest expense, because anyways, that is going to be subtracted here. So what we add back here is plus depreciation, right? And then after that, we have the changes in working capital. So we can say this plus or minus capital expenditure, again plus or minus changes in working capital, or changes in, let's say, non-cash working capital, correct? So this FCFF component is taken care of. And then what we do is we reduce the principal repaid, right? We reduce the principal repaid, then add any sort of, or rather, let's reduce one more thing, which is the preference dividend, right? Preference dividend. Then add back any new debt raised. Now, new debt raised will include your preference shares also, right? So new debt will include your preference shares also. And of course, if you're paying any preference dividend, that needs to be subtracted. And if you're issuing any new debentures, getting new loan, or new preference shares are issued, that also going to be included in this aspect. Okay, so that's how we compute the FCFE from the balance sheet on the P&L. Okay. So if you're taking from balance sheet from retained earnings instead of net income, so increase in the retained earnings is what you're going to consider. The changes in the retained earnings. Okay. So you compute this free cash flows, and then you go ahead with discounting those free cash flows to current level by using, obviously, cost of equity to arrive at the value of the shares. Okay. Now, let me just do one thing. Let's just practice this questions. I mean, practice this concept with the help of a question. Let's say in the assignment, let's take up this question. 1 second. What was this question number? Yeah, question number 10, guys. Let's try to solve question number 10. I just give you a minute's time to please look into the question, try to understand what is given in the question, and then we'll take it up for the solution. Question number 10, guys. Just a minute's time for you to read the question and try to grasp the numbers that we have, the meaning of the numbers rather. Yeah. So calculate the value of the share from the following information. Profit after tax of the company is 290 crores. Equity capital of company is 1300 crores. Par value of the share, which is the face value of the share, is 40 rupees each. Debt ratio of the company is debt upon debt plus equity. Now, they have clearly specified what is this debt ratio. Debt upon debt plus equity is 27%. Long run growth rate of the company is 8%. Beta is 0.1 and risk-free interest rate is 8.7%. Market returns are 10.3%. Capital expenditure per share. So they've given us what is the capex per share. Okay. So right now, we instead of capital expenditure, we'll say capex because that's a generally accepted term in the industry also. Then depreciation per share is 39 and changes in working capital is also 3.45 per share. So they've given all the numbers in per share basis, right? And we have to calculate the value of the share, right? So for the value of the share, we need to compute the free cash flow for equity on a per share basis. So let's first try to get the number of shares because we have the equity capital of 1300 crores, but then the number of shares also matters. Yeah. So number of shares. What will be the number of shares, guys? Number of equity shares. The number of equity shares will be 1300 crores is the share capital, which are divided into each of the shares being having a face value of 40 each. So we can say it is 1300 divided by 40 each. So that's 32.5 crores, right? 32.5 crores is the number of shares that we have. Then we need to get the FCFE. Now to calculate the free cash flow for equity, the question doesn't have any sort of preference shares or anything with regards to loan repayment or additional debt being raised. But still, I'll first initially write down the entire formula over here so that we'll be able to get an idea what all we need to compute, right? So we have to get it like per share basis. So if it is FCFE per share, instead of net income, how is this formula going to get revised? Can I say EPS, earnings per share? Correct, guys? Because we are going to calculate free cash flow for the equity on a per share basis. So this net income was for the entire equity shareholders. If I want to get it for each of the shares, then we can get it as simply as EPS because all other numbers that you see, capital expenditure per share, depreciation per share, so everything is given on a per share basis. And therefore, we try to calculate FCFE on a per share basis only. So EPS, of course, we calculate the EPS first. So let's try to work out the earnings per share. Now for earnings per share, do we have the profit after tax given to us? par value of the share, debt equity, profit after tax of the company. Yes, 290 crores. So what will be the EPS, guys? 290 divided by 32.5. Right? What will be the EPS? EPS is 8.9230, or let's take it as 8.92 on a per share basis. Right? So you can take it maybe up to 3 decimals also. Yeah, 8.923 is the earnings per share. So that's first part is done. Now then to this EPS, we will add, of course, depreciation on a per share basis. I think that is also given to us. Yes, depreciation per share is given to us. Then how do we go about the other aspect now? Yep. Then after depreciation, we have the capital expenditure. Do we have capital expenditure given to us? Yes, capital expenditure per share is 47. That is also given. Okay. So it's going to be depreciation per share plus or minus capital expenditure. Then do we have the change in working capital? Yes, that's also given to us on a per share basis. So we'll say plus or minus change in working capital on a per share basis. That also given. Now, principal repayment, any sort of new debt being raised, preferences, that is something which we are going to tackle now. Okay, so we have the EPS. Then we add to it depreciation per share. So let's say add back depreciation on a per share basis. So 8.923 plus we will add back the depreciation on a per share basis. What is the depreciation amount given to us on a per share basis? 39. Yeah, so you can say it is 39. Depreciation per share basis is 39. Then there is a capital expenditure being undertaken. Capital expenditure being undertaken 47. So what will happen to this 47 capital expenditure? Do we have to is this going to be addition or is it going to be subtraction? It's going to be subtraction, right? Because we are spending capital expenditure spending. Basically when you are going to sell the asset, then you will add it, right? So when we are spending it, it's a cash outflow for us, and therefore we need to subtract the capital expenditure. So capital expenditure is amounting to 47, right? So our capex is increasing by 47. Then changes in working capital. Changes in working capital is 3.45 per share. So working capital is basically, it's a positive number, so we are increasing the working capital. So if there is an increase in the working capital, is it going to be considered as an outflow or as an inflow? Is it going to be considered as an outflow or inflow? Yes, tell me guys. When you have a working capital, you're spending on working capital, like you're acquiring more stock, you're keeping more sort of debtors. Will it be a cash inflow or outflow? Of course, it will be cash outflow, right? It will be a cash outflow because you're maintaining stocks. You will buy stock, you need to pay for it, right? So less changes in working capital. So changes in working capital is given on a per share basis as 3.45, right? Okay, but wait a minute. We have this principal repaid, preference dividend, this component yet to be adjusted. And for that, you need to look at this number over here. See, debt ratio of the company is 27%. Debt ratio of the company is 27%. So when we say debt ratio is 27%, means any new capital or any new funding that is happening, like you're increasing your working capital, you're increasing your capital expenditure, that is not going to be funded fully by equity or fully by debt. Rather, it is going to be funded in a ratio of what? 27% is going to be funded by debt. So whatever is the increase in the capital expenditure, whatever is the increase in the fixed asset, and whatever is the increase in the working capital, that is going to be funded by 27% by way of debt. So what is the debt that we are raising? What is the amount of debt that we are raising? Because the addition that we have, the depreciation of capital expenditure or the working capital expenditure, it's not fully funded by equity shareholders, or it's not fully funded by debt. So I need to add that component, which is new debt raised, because as your capital expenditure is increasing, which means your fixed asset is increasing, your working capital is increasing. So that increase is essentially funded by what? Partly by debt and partly by equity. So we want to know what is the component which is funded by debt, because that will be the new debt raised. So let me just get over here, new debt raised. Okay, so let's calculate the new debt raised. So to calculate the net new debt raised, we will say, what is the change in non-current assets? How much is the change in the non-current assets, guys? Can I say 47 is the capital expenditure, out of which, of course, 39 is getting depreciated. So the increase, net increase in the capital expenditure, which is capex minus depreciation, is 12. So your fixed assets are increasing by 12. And what is the change in current assets? What's the change that we are observing in the current assets, guys? So change in current assets is going to be by 3.45. Correct? The change in current assets is 3.45. So total additional funds to be invested, can I say there's going to be a total additional fund investment of 15.45 in the company. So non-current assets are increasing by 12 crores. Your current assets are increasing by 3.45 crores. So additional capital infusion, additional capital funding that is going into the business is 14.45. Now, is this entire 14.45 funded? Is this entire 14.45 funded by equity shareholders? No. What portion of this is funded by debentures? What portion of this is funded by debentures? 27%, right? So proportion of additional fund requirement funded by debt. Can I say funded by debt? It is 27%. So can you tell me what will be the new debt raised? What will be the amount of new debt raised? Can I say it will be 15.45 multiplied by 27%, which is 4.1715. This will be the new debt that is going to be raised. Okay. Karthik is saying the change in non-current asset is not clear. See, your capital expenditure is 47. Karthik, capital expenditure, like it's 47, but there is a depreciation of 39. Right? So your gross working capital is increasing by 47, but then you are claiming there is a depreciation. So increase in the net current assets, non-current assets, in your balance sheet, you will observe that your non-current assets are increasing by 12 only. Right? So that's the additional capital infusion which we are taking. Okay, that's the net capital expenditure, which is the fixed asset purchase less depreciation claim. Okay, so this is what you're going to observe in the balance sheet. In the balance sheet, you'll observe that your non-current assets has increased by 12. Okay, so new debt raised is 4.1715. Now, what will happen to this new debt raised in our calculation of FCFE? Will I add it? Yes. So we'll say add new debt raised. So new debt raised is 4.1715. So if we look at what is free cash flow for the firm on a per share basis, because there's no adjustment of preference dividend in this case. So of course, this is going to be a subtraction. This is also going to be a subtraction, right? So this is simply going to be sum of is it this new debt raised? Yeah, 39. $8.923. 1 second. There is some problem, I suppose. 1 minus B. I think this is 47 minus 39. Yeah, that is 8. My bad. There was a calculation error. So 8. So we can say new debt raised is 3.0109. And yeah, this is like 0.5645 is the 5646 rather. Yeah. So this is free cash flow for equity on a per share basis. Okay, yeah, 47 is the increase in the capital expenditure. 39 is the depreciation that you're claiming. So net change in the capital expenditure, net change in the fixed asset you'll observe is 8. So now we have free cash flow for equity to be 0.5646. Now this free cash flow for equity needs to be discounted to the current value, and for that you can observe there is a long run growth rate. Just like in dividend, we are observing that growth rate of the FCFE is also going to be, let's say, if the company is going to grow at 8%, so maybe your FCFE is also assumed to be going at a same 8%. Then we have beta, risk-free rate, and market return. Can you give me the CAPM return here, guys? Using these two lines, can you give me the CAPM returns? The beta, risk-free rate, and market return is given. So what will be the CAPM return? CAPM cost of equity. What will be CAPM cost of equity? Yeah, CAPM cost of equity. So we have like risk-free rate given to us. Risk-free rate is 8.7%. Then we have beta of 0.1. Right. Then the market rate of return. The market rate of return is 10.3%. Okay. So now we have to get like the CAPM, KE using CAPM. So KE using CAPM will be 8.7%. Then we will be like plus 0.1, which is beta, multiplied by 10.3% minus 8.7%. So what is KE? How much is KE, guys? 8.86. So KE works out to be 8.86%, right? Now, since we have the KE as 8.86%, now what can we say about the value of the share? Of course, it's going to grow at constantly at a rate of long run growth rate is anyways 8%. So we'll say growth rate is 8%, and therefore P0 will be equal to FCFE multiplied by 1 plus growth rate, because we are assuming that FCFE is belonging to the previous year. The FCFE into 1 plus growth rate divided by KE minus growth rate. So this works out to be FCFE of 0.5646 multiplied by growth rate of growth factor of 1.08, and then we say this to be 1.08. Yeah, this is going to be divided by K minus G. K is 0.0886 minus 0.08. So when we do this, what's the value that we are getting, guys? P0, what's the price? 0.5646 multiplied by 1.08 divided by 0.0886 minus 0.08. So value of the share 70.90. Price of the share is coming out to be 70.90. Are we good, everyone? Yes. So the difference over here was to calculate this new debt raised, right? So that's a bit difference. Otherwise, it's a straightforward thing. You have to just get the FCFE on a per share basis and then take it with the furtherance thing. Clear? Shall we take up one more question, guys, for the same FCFE thing? FCFF or FCFE, both the ways. Yep. Okay, let me just see which one shall we really look at. Second. Okay, there's no as such any additional question here, but okay, let me just take an example for you to practice. Let us say profit after tax of the company is 3,000 crores. Okay, then depreciation is, let's say, 450 crores. Okay, then we have working capital opening working capital was suppose 670 crores. Okay, then working capital closing is, let's say, 880 crores. Okay, then non-current asset, or let me just give you like capex, capital expenditure of 150 crores. Okay, then opening working capital, closing capex, new debentures, let's say, have been issued to the tune of 120 crores, and bank loan repaid is suppose 250 crores. Okay. Tax rate is 30%. Then preference dividend paid is 45 crores. Equity dividend paid is, let's say, 70 crores. Interest paid is, suppose, 47 crores. Okay. Yeah. So now, can you compute the FCFE first? Compute the FCFE from this database. Compute the free cash flow for equity from these numbers. You've got, let's say, 20 minutes, not 20 minutes, my bad. 2 minutes for this guys. Try to get the FCFE, free cash flow for equity from these numbers. Free cash flow for equity. Yes. So free cash flow for equity, you start with profit after tax of 3,000 crores. And of course, what are the adjustments that you're going to give to this? The same thing over here. Add back the depreciation per share, less capital expenditure. So add depreciation. So depreciation will be 450. Then less any capital expenditure, less the capital expenditure, which is 150. Okay. Then working capital, less increase in the working capital. So how much is the increase in the working capital? We'll say earlier it was 670, now it has become 880. So 210 is the increase in the working capital. Then what all things do we do additionally? One is the new debt raised and the preference share adjustment. So we'll have to say add new debt and also less debt repayment. So new debt will be 120 crores coming in and 250 has been repaid. Right? Then the other aspect, anything do we have to do with the equity dividend and preference dividend and interest paid? Out of these three, which one is really going to be considered in the calculation of FCFE? We adjusted the depreciation, we adjusted the capex, we adjusted the working capital expenditure, we adjusted the debt. Preference dividend, is it going to be adjusted? Yes. Less preference dividend. So preference dividend is basically 45 crores. So that is something which has been paid out. So that cash flow is not available for the equity shareholders. And of course, equity dividend paid is something that we are not going to subtract. Right? So our FCFE, free cash flow for equity, will be simply the total of this, which is 2915, correct? Getting this FCFE of 2915. Just check. 2915 is the same FCFE which you are getting. Yes, same. Okay. Now let me add one more thing. Let me check. Do you really remember the previous day's concept? Now we know FCFE. Of course, this is FCFE 0 as 2915. Now I'm telling you that the growth rate in this FCFE will be 35%, or let me take it as 40% for year 1 to 4. And then it will be 10% for year 5 onwards. Okay. Cost of equity is, let's say, 15%. Can you calculate? And let's say I'm telling you that number of equity shares is suppose 100. So this is so many crores, right? And let's say the number of shares is also so many crores. Can you get the value of the share by taking the present value of this FCFE, everyone? Can you calculate the value of the share using the present value concept of FCFE? The same concept which you have applied for calculating the present value of equity shares using dividend discounting model. Remember 2 growth rates, super growth rate, super high growth rate, and a normal growth rate. Do you remember this, guys? We have done in the last class. Correct? So can we get the value of the shares over here? Yes. So first what we need to do is we need to get the FCFE per share. So on a per share basis, FCFE stands as 2915 divided by 100. So that's like 29.15. Now this is going to grow at 40% every year. This is going to grow at 40% every year for 4 years. And then from 5th year onwards, it's going to grow at a constant rate of 10%. So you have to get the present value of all of it. So try to give me the value of the share using discounting all the future cash flows. First, what we need to do is for the respective years, we need to get the FCFEs. Right? Now that FCFE will be, of course, dependent on the growth. And of course, we'll say particulars. Year, growth, and FCFE. Particulars is like FCFE, and let me just call it as cash flow. Yeah. So FCFE in year 1, 2, 3, 4. Also in the 4th year, we will have the value of the share in year 4. So growth rate, here it is going to be 40%. And we know we need to get the value in year 4. Now, how do we get the value in year 4? Can you help me? How do we get the value of the share in year 4? How do we get the value of the share in year 4? Can I say FCFE in year 5 divided by KE minus the growth rate? First, we need to get the value of the share in year 4. Let me write down the cash flows as 29.15 multiplied by 1.4. Then it is obviously this multiplied by 1.4. So every year it's going to grow at 40% rate. And here we need to get the value of the share in year 4. Now for that purpose, we'll have to take like FCFE of year 5 will be 111.98 multiplied by growth rate, which is 1.1, and then this thing is divided by KE, which was 15% minus a growth rate of 10%. So when we solve it, we should be able to get the cash flow in year 4, which will be 11.98 into next year 1 plus G divided by 0.05. So this is 2463.62. That's the cash flow. Correct, guys? We got the cash flow numbers. Now we have to use the PV factors at the rate of 15%, right? Yeah, PV factor at 15%, then give me the PV. Give me the value of share, guys. I've given you the whole idea, what is to be done. You just need to calculate and give me the answers. Come on, solve it and give me the answer, guys. Give me the price, value of the share today. Okay, I've got the first answer. Interest not considered while calculating FCFE. Savita, we have started with profit after tax. So interest would have already been subtracted from PAT. Right? So therefore, we don't consider the interest over here. Right? So we are calculating free cash flow for equity. So interest would have been already subtracted while calculating the profit after tax. And therefore, that is not again subtracted in this case. Okay. Okay. So let me just see the answer. I'm getting few answers from the students. So yeah, 1604, correct. Some rounding up here and there, that's okay. 1604. One 1603.99, 1604. Everything's fine. That's okay. Okay, great. That's about the free cash flow for equity model, guys, to calculate the value of the share. Now, let's do some more questions from the assignment part. to get a hand of variety of questions that we may observe. So let me go to the assignment and start solving few questions. I know there is a 3-stage model pending and also EV EBITDA model pending. So let's do 1 or 2 questions and they'll come back and do with the 3-stage and then something called as EV EBITDA, enterprise value and EBITDA concept. So like we are done with question 1 is done. Question 2 is pending, sir, which is about the rights valuation. So let's do this rights valuation in question number 2. Okay, a minute time for you to quickly read the question. Please read the question. Read the question, guys, carefully. Okay. ABC Limited shares are currently selling at rupees 13 per share. There are 10 lakh shares outstanding. The firm is planning to raise 20 lakhs to finance a new project. So we are looking for getting new funds of 20 lakhs for a new project. ABC Limited shares are currently selling at 13 per share. There are 10 lakh shares. The firm is planning 20 lakhs. Okay. Required. What are the ex-right price of the shares and value of a right? If the firm offers 1 share, 1 right share for every 2 shares held, and secondly, the firm offers 1 right shares for every 4 shares held. How does the shareholders' wealth, which is, suppose a shareholder is holding 100 shares, change from 1 and 2, and how does the rights issue increase the shareholders' wealth? Okay, so that's what we are going to demonstrate over here. So first, we have got 10 lakh shares. Existing number of shares is 10 lakh. And we want to issue, let's say, shares, 1 right share for every 2 shares held. So we can say existing number of equity shares. Existing number of equity shares is 10 lakh. Right? Existing number of equity shares is 10 lakh. And right shares that are being offered is 1 share for every 2 shares and 1 right share for every 4 shares. So there are 3 portions to it. Okay, let me first write down the common part. Currently selling at 13, so market price of share. Of course, this is the market price of the share before rights. It is 13. Fund requirement. Funds required is, let's say, 20 lakhs. Okay. The funds that we need is 20 lakhs. So there are 3 different cases for the question. The first is, what are the ex-rights price of the shares and the value of the right? If first is the firm offers 1 right share for every 2 shares. 1 right share for every 2 shares being issued. So we can say, first case, rights issue of 1 for every 2 share. So what will be the number of rights shares to be issued? Can I say it will be 10 lakh divided by 2, which is, of course, 5 lakh shares are being issued, right? So we are issuing 5 lakh shares. Correct? Okay. We want to know what is the ex-rights price and the value of the rights. Now, at what price are the shares going to be issued over here? What is the price of the right shares? Yeah, tell me, what will be the price of the right shares? Can I say 20 lakh is being funded by 5 lakh shares? Rupees 20 lakh is being funded by 5 lakh shares. So that will be like 20 lakh divided by 5 lakh. So each of the shares is going to be worth 4 rupees. Did we get this point, everyone? How we determine the price of the right shares? Yes? We need 20 lakh and we say 5 lakh shares are going to be issued. So let us say 4 rupees will be the price at which the shares are going to be issued. Now, I don't know if you can remember something called as earnings per share accounting standard in your CA Inter, you might have learned something called as theoretical X rights price. Theoretical X rights price. Do you remember? In your accounting standard, AS20. In fact, even in final, you might have seen in FR also. How do we compute the X rights price, theoretical X rights price? So we say, originally, the company had 10 lakh shares and each of the share was worth 13. Now you are going to introduce additional 5 lakh shares at a price of 4 rupees. So the share, the company which was worth, let's say 10 lakh into 13, which is 1 crore 30 lakh, the value increases by additional 20 lakh. Right? The value increases by additional 20 lakhs. So total value of the company is now 1 crore 30 lakh plus 20 lakh. And then, but the number of shares that we have right now is originally it was 10 lakh. Now you are issuing additional 5 lakh shares. So the theoretical X rights price will be, can I say 10 lakh multiplied by 13 plus 5 lakh multiplied by 4 and then divided by 1 crore 50 lakh divided by 15 lakh. So can I say theoretical X rights price of the share is 10 rupee? Correct, guys? Are we getting this X rights price as 10 rupee? Right? Okay. Now, think from the point of view of a shareholder. He is going to get the right shares at a price of 4 rupees. Whereas the X rights price is 10 rupees. Right? So what is the benefit that the buyer of this right share is going to get? What is the benefit that the buyer of the right share is going to get? What is the value that the buyer is getting due to rights issue? Can I say value of right share? Can I say it is 10 rupee minus 4 rupee, which is 6 rupee? Correct, guys? 6 rupee is the value of the right. Not value of the right share, I can say it is value of right. So value of the right is 6 rupees. So the question asks us, what are the X right price and the value of a right? Value of a right will be 6 rupees per right. But if I ask you, what is the value of right per existing equity share? It is of course going to be 6 divided by 2 because 6 divided by 2 it's of course going to be 6 divided by 2, which is 3 rupees. Now why do we say that it is 3 rupees? Because every share you're going to get, like every one share, you're going to get half a right, because they've stated that for every 2 share you have 1 right. Right? So for every 2 share, if you have 1 right, so it means for each of these shares you have got a half right. and therefore we say it is 3 rupees per existing shares. Rights of the value of the rights per existing share is 3 rupees. Now the same thing calculation is required for rights issue every 4 shares. For rights issue for every 4 share. Can you do it? Can you do the same numbers for 4 shares, everyone? Can you try it? Yes. Sure. Solve it and quickly give me the answer. A minute's time for you. Give me the theoretical X rights price, value of the right, and value of right on a per existing equity shares. So X rights price is 12. Value of right is 12 minus 8, which is 12 per right shares. No, sorry, 4 per right share. And value of right per existing share, this will be 4 divided by 2, which is 2 rupees. Yes, are we getting this, everyone? 4 by? Yeah, so there are 4 shares issued here, so there will be 1. So value of right per existing share is 1 rupee. Right? Because X rights price is 12 and we can get the shares at a price of 8. Right? So the value of the right, the power that the right has given you is giving an additional benefit of 4 rupees. So that is a 4 which is value attached to the right, not the right shares. Okay. Because of that right, because of that power, you're going to get 4 rupees as the additional wealth addition, because you're going to pay 8 for 1 right share, and that share is going to become 12 rupees. So that additional value which you're getting is what we mean by the value of the right, which is 4 rupees per right. Okay, done? Have you all done with this? The second part of the question, guys? Yes. Okay, then let's go for the third part. How does shareholders' wealth holding 100 shares from 1 and 2, change from 1 to 2, and how does the rights issue increase the shareholders' wealth? So what is the impact on the shareholders' wealth when the company offers right shares? As per one right share for every 2 shares, and or like one right for every 4 shares. Change that we have in the wealth of the shareholder, that is what we want to know. So let us say calculation of effect of rights on wealth of investor. Calculation of effect of rights on wealth of investor. So there we have the first part as 1 to 1 for 2 rights. One right, or I can say this is one rights share for 2 shares. Okay. So we want to see what is the impact on the wealth. So for that, we need to look at what is the wealth before and what is the wealth after. Okay. So what is the wealth of shareholder before rights? Can you tell me what is the wealth of the shareholder before rights? What is the wealth of the shareholder before rights? Yeah. What is the wealth before rights? Before rights, the share was trading at a price of 13. And let's say he's holding 100 shares. So of course, 13 multiplied by 100, we can say it is 1300, right? Then can you tell me what is the number of right shares? Number of right shares. What is the number of right shares he's going to get? 100 divided by 2, which is 50. Right? So what is the amount paid? Amount paid for right shares. What is the amount paid for right shares? Can I say 50 multiplied by 4 rupees per share? So we have paid like 200. So amount that we are paying for right shares is 200. Correct? So amount paid for rights shares is 200. Now, if I ask you, what is the wealth or value of total value of all shares after rights? Now, of course, he's having like 150 shares. He's having 150 shares, and each of those shares were valued at 10. Can I say that's 1500? But sir, this wealth has not increased because of something, right? This wealth has increased because we have contributed less amount paid for rights. So what's the amount that we are paying for the rights? It's 200. So net wealth, can I say it is still remaining same, 1300? Net wealth is still remaining same, 1300, because there is no change, because the 200 increase in the, whatever amount you have paid, that is just the increase in the value of the wealth. So if you're paying and acquiring an asset anyways, right? And that cash is just getting converted into the shares. Why using 10 instead of NPS? Value of shares after rights, no? So once the rights have been issued, the shares will be trading in the market at a price of 10. So therefore, we say it is 150 into 10, 1500. Okay, this was the value before the rights issue. Okay. Bonus issue, depends how the price movement happens. If the price is moving as per theoretical basis, even after bonus, you will not find that there is an increase in the wealth. Now, the same answer you're going to get even if you're going for one right share for every 4 shares. Right? So you'll get the same answer. 1 into 100, which is 1300. The number of rights issue will be, of course, 100 divided by 4. So you will be receiving like 25 shares. Amount that you're paying for rights is 25 into 8, which is 200. And then value of all rights. Value of all shares after rights will be like 125 multiplied by what's the theoretical exercise price in the second case? 12 rupees. So can I say, again, there is no change in the wealth of the shareholder. Did you get it, everyone? Yes? Okay. Now, let's take up another question. So 3 is done. Now, it's time for question number 4, guys. Information, 2%. Calculate the present value stock of ABC Limited. Is its stock overvalued? If stock price is 35, return on equity is 9%, and EPS is 2.25. Show detailed calculation using P multiple approach and earnings growth rate approach. Okay, so we have to use 2 approaches. One is the P approach, price to earning approach, and the other is about the earnings growth model. Okay, so current dividend is 0, which is 2.5, discount rate is 10, and growth rate is 2%. So we can simply get the price 0 is equal to, right, and then divide it by 0.105, which is 10.5% minus 0.02. So this is like 2.5 multiplied by 1.02 divided by 0.10430. Correct? So that's the first part then. The second part is its stock overvalued. You have to compute whether it is overvalued or not. So for that, we know the market price per share is given. Market price per share is 35. Return on equity is 9% and EPS is 2.25. So 2 approaches are to be used. One is the P multiple, other is the earnings growth approach. So let's use P using the P multiple approach percentage. EPS is given as 2.25, but the question has given us return on equity number. Return on equity is 9%. Can I say PE will be what? 1 divided by 9%, which is 11.11. Okay. I hope you're aware of this. Market price per share, or I can say value of rupees per share. So value of the share is 25 rupees, right? Now, but the current market price is 35. So tell me, is the stock overvalued or undervalued? Of course, the share is overvalued. Share is overvalued. Then the next approach is earnings growth model. Now, when we say earnings, take the growth that is anticipated in the earnings. Now, in this, there is no growth which has been given, but there obviously it is quite implied that we have to use the same growth using earnings growth model. E0 equal to EPS in year 1 divided by KE minus G. Right? So first we need to get the P0 value. Now, of course, to get the EPS 1, we can say EPS 0. So P.25. So 2.25 multiplied by growth will be, of course, the growth rate which they have specified in the 0.5%, right? So cost of equity is 0.105 minus 0.02. This works out to be 2.25 minus 0.02. P0 as is it 28.16, correct? Was okay, return on equity you can take, sorry, in this case, yeah, because it's a separate thing altogether, and they've given the what you say return on equity as a separate question altogether. So it will be 0.09 minus 0.02, correct? So it will be 0.07, and that's giving us answer as 32 points, return on equity of 9%. So that return on equity is what the equity shareholders might be expecting from us, and therefore are we good, everyone? Yeah. Are we good with this? So what could be the case? Overvaluation, undervaluation? The share is overvalued or undervalued? Yeah, because the current market price is again 35. So the share is okay. That's nice. So you've done quite a good number of questions. Now and understand what's maybe we'll do one more question and then we'll go for 3-stage model and something called as enterprise. Are we all back, everyone? Yes. Okay. Now let's look at the three assignment part. Okay. So first aspect, let's say a three-stage cash flow model, I can say. Okay. Currently, suppose the dividend is having a value of 20 rupees per share. And when we look at currently the company is growing at a very rapid pace. So let us say it is growing at 30%. And this growth rate is going to be there for 30%. After 4 years, the growth rate is going to linearly come down. After 4 years, the growth rate is going to linearly come down. Or I can say it's going to slow down. It's never going to be a case that after 4 years, suddenly the growth rate is like reduces from 30 to 10%. Is that really going to be a case? Just think practically. Previous year, you were having a growth of 30%, and now this year, you suddenly have a growth rate of the cash flow. Is it possible? Yeah. Is it possible that up to 4 years it is 30%, and then after 4, that sounds something cases going to slow down. The growth rate is going to reduce bit by bit. So part by part, the growth rate is going to get reduced. So we say, let's say, I said year 9 onwards. So from 9 year onwards, year 5 to 8 is the transition period. This is the 2 years, and then it will start reducing. So if we write down the years and the growth rates, like year 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, or let me call it up to this one. Now, first year, you observe a growth rate of 30%. Second year, also you observe a growth rate of 30%. So this goes on. You have a growth rate falling to 10%, and which you will face a high growth rate of 30%. And then more till year 8, there is growth rate. And it has to be linear. It has 5th, 6th, 7th, and 8th, 10%. 5%. So let us say 30 minus 5%. And this is what we observe. No, it's not 5% fall, right? Because you see, 8th year it becomes 10%, plus 4%. Again fall of 4%, again fall of 4%, again fall of 4%, and then from 9th year onwards, you have a fall of, I have a constant growth rate of 10%. In growth rate per annum in transition phase. Growth rate per annum that's going to happen. Simple, high growth minus stable growth, 9th. Right? So we have to make it by 4th till 9th. So can I minus low growth here? So you can see we have used the same formula. High growth here was minus high growth here. So low growth here is starting from 9, right? And all in the growth rate, yes. So year 4 is the high growth rate. Year 9 is where you are achieving the stable growth rate, right? So this is how we are in two-stage cash flow models. In two, right? And we used to say that 30, 30, 30, 30. And then suddenly from you say 5th year, you said that it is now 10%. And then suddenly it falls. Now, if I just show you graphically, which makes more sense, let's say I insert a chart just for your understanding. Okay, this is what this really look like. If you look at this chart, we had a chart like this. I will look at it. So the first, this actually makes more sense. But the problem is, when you're looking at this transition, you'll have too many data points. You'll have too many data points and there are multiple growth rates, right? So different growth, calculate the value of the share is also going to be remaining this. Let me just take it to a separate slide and yeah. So if it is, these are the growth rates. If suppose these are the growth rates, correct? First year dividend will be D0 multiplied by 1.2. Correct, guys? Yeah. Sorry, 1.3. Let me take it like this. 1 plus 30%. So 26 will be the dividend in year 1. Then in year 2, it will be the first year growth rate, right? And then we can just, we know that up to 8th year, because now we want this to be 7, D8. Now we need value in year 9. Now how do we get the value in year 9? K minus G. K minus G. Correct, guys? Of equity is 15%. Right, so let's say cost of equity is 15% minus the growth rate is essentially 10%. So we can get the value of the company in year 9. Value of company in year 9. Sorry, value of company in year 8 by taking the dividend of 9th year. So this will be 129.9 year, 2598. And then what will be the next task? Can you tell me what will be the next task? Once we have got the linear amount of dividends and the value of the company in year 8, can you tell me what will be the next task to get the value of the share? What will be the next task to calculate the value of the share, guys? Simply, we have to take the present value of these cash flows. Correct, guys? Yes, students? We'll write down the PV factors at the rate of 15% and then we take the PV. Right, so PV factor taken at 15% and then simply derivate the PV over here. And this PV factors multiplied with the cash flows. Sum total of all the values. So value of the share will become 1110.52. Okay. Is this phase clear? The 3-stage cash flow model, is it clear to everyone? Are we good, everyone? 3-stage cash flow model, nothing different. It is just the gradual fall in growth rate that we consider in the 3-stage cash flow model. I'll just give you a couple of minutes. If you want, you can just copy these things quickly. Just a couple of minutes. Copy these things quickly if you want to. Then we'll go for some questions and then EV EBITDA. Yeah, let's take up EV EBITDA also discussion for now only. Or we'll do couple of minutes for you to write it down. Explanation is easy to understand, right? So just follow this explanation. Okay. Difficult to have the simple understanding of it. So when we put it in numbers, it becomes quite intuitive for us to understand in a better way. Okay, so are we all done? Shall we go for the next concept, guys? Shall we take up the next concept? Everyone? In exam, if we not put the formula, then it will be okay. Of course, it is all fine. Make sure you write down all the numbers and facts properly. Because very few, as Sir was talking about that in the last class also, some of the formula you need to by heart or mug it up, because the logic may not be easy for us to understand, because the concepts there are arrived from physics or higher level mathematics. But wherever it is simple mathematical formula, we can essentially derive it and try to understand it and implement it our way. That's much more easier and simpler to work. Correct? Yeah. So let's go for next. Are we all done, everyone? Are we all done? Shall we go for the next concept, which is the enterprise value? So we'll do this concept and then enterprise value, which means basically the value of the business as such. Right? So enterprise value is simply value of the entire business. Right? So how do we calculate the value of enterprise, value of the entire business or entire organization? Right? So enterprise value is simply value of all businesses of an organization. Right? So its enterprise value simply is a value. It will comprise of all the businesses, be it core business or non-core business. Like if I ask you, let's say we want to undertake enterprise value for Reliance Industries Limited. It will not include only the value of its refinery business, but it will also include the value of its retail business, value of telecom, value of plastic manufacturing. So whatever sort of businesses you are into, the combined business value is simply taken as the enterprise value. Okay, so this enterprise value is simply computed as value of all business of an organization. So enterprise value is calculated as market value of all shares plus market value of all debts, right? Market value of all shares plus market value of all the debts, right? Minus any cash balance that you have, right? So enterprise value is added and remove the cash component from that, right? Now what will be cash component that will be removed? Yeah, cash. Why do we remove the cash from this? Because cash is generally not an asset which is working for you. Do you think that keeping idle cash in bank account is going to generate some return for you? If you're holding idle cash, is it going to generate any value for you? Is it going to generate any value? Tell me, guys. Like suppose in your wallet you have 5,000 rupees. So over a period of years, is it going to generate any value for you? No. Cash is not going to generate any value over a period of time. The amount the asset in which you invest cash is going to generate value for you. Like suppose you invested 5,000 cash in purchasing shares of a company. Now, is that share going to generate value for you? Yes, the share is going to generate value because you have invested it. So cash, when invested, then only it's going to give you some value creation or value generation. Before that, it's not going to give you any sort of value. And therefore, we say, sir, when we are talking of enterprise value, we only need to subtract the cash component from it. Okay. So instead of, just looking at the profitability, just looking at the, return on equity numbers, nowadays business entities focus more on this enterprise value. They focus more on the enterprise value because they say that the ultimate objective of the company should be to increase the enterprise value of the company. I mean, the market value of the shares and debentures should increase because of the greater confidence of the shareholders on us. And therefore, our focus is to increase the enterprise value. Now, this enterprise value number, it is, essentially taken with regards to the other aspects, like how do you compare your enterprise value. Now, can I compare my enterprise value with other enterprise value? No, because my business is different, right? My business is different. The other entity's business is different. Even if the business is same, can I compare the enterprise value of TCS with enterprise value of Infosys? No, we cannot compare because the enterprise value depends on certain parameters. And therefore, we, essentially are looking for some multiples. So EV multiples are compared to measure performance of enterprises. Now, some of the EV multiples are, it could be EV to sales, or it could be enterprise value to EBITDA, like earnings before interest, tax, depreciation, and amortization. Before depreciation, before interest, whatever is the value whatever is the EBITDA number that we have, that is going to be compared with the enterprise value to calculate what will be the wealth that we have in the company, or what is the overall performance of the company in that case. Okay. Now, okay, so we simply compare these multiples to evaluate which of the companies are having greater value or which of the companies are having a lesser values. Now, of course, to do this, let's just try to solve a practical problem. Maybe let me see, where is that question number, just a moment. The question. Okay, there wasn't a question as such in enterprise value. Second. There is a company X and there is a company Y. Now, when you look at the ratio, enterprise value to EBITDA, let's say here it is 10 and here it is 15. So for this 10, we can essentially say of EBITDA, for rupee 1 of EBITDA, rupees 10 is the value of firm, or rupee 10 is the enterprise value, right? Whereas this one, if you look at the EV to EBITDA number, you find that for rupee 1 of EBITDA, the enterprise value is 15. So what do you say about this? Which of these two companies have performed better? Which of these two companies have performed better? X is having 1 rupee, for 1 rupee EBITDA, X is having an enterprise value of 10. Y is having an enterprise value of 15. So can I say greater value generation has been done by which company? Company Y. Okay, so that is the concept that we have with regards to enterprise value. Now let's go for some of the questions to solve the practical problems from the equity valuation part. Let me just open up the assignment. Yeah. I think question 5, 4, 1, 2, 3, 4, 5 is done, 6 is done. And let's try to do question 8 now. Question number 8, guys. ABC Limited has been maintaining a growth rate of 10% in dividend. The company has paid a dividend at rupees 3 per share. The rate of return on market portfolio is 15% and the risk-free rate of return on the market has been observed at 8%. Beta coefficient of the company share is 1.5. You are required to calculate the expected rate of return on company shares as per CAPM model and equilibrium price per share by the dividend growth model. Okay, so it has been maintaining a growth rate of 10% in dividends. This is question number 8. So growth rate is 10%. The company has paid dividend at rupees 3 per share. So D0. D0 D0 is 3 per share. Okay, then the rate of return on market portfolio is 12%. So can I say this is RM? I think this goes into a different tangent altogether because market rate of return is 12%. Risk-free rate of return in market is, so RF is like 8%. Okay. Beta coefficient of the company share. So we have beta as 1.5. Okay. Now you're required to calculate the expected rate of return on company shares as per CAPM model and equilibrium price per share by dividend growth model. Now, of course, to calculate the dividend, we know the growth rate. From this, we can get the D1. What will be D1, guys? D1 will be, can I say 3 multiplied by 1.1? So that's 3.3, correct? So dividend will be 3.3. Now to calculate the value of the share using, P0, we need D1 upon KE minus G. So P0 is D1 upon KE minus G. So we need to get the D1 already obtained, but what will be the KE? So for KE, we'll have to use the CAPM model. So for KE, CAPM model will be 8% plus 1.5 multiplied by 12% minus 8%. Yeah, so KE works out to be, how much, guys? 8% plus 1.5 multiplied by 4%. Yeah, KE is 14%. And of course, price will be 3.3 divided by 10% minus, sorry, not 10%. 3.3 divided by 14% minus 10%. Right, so P0, current market price, is 3.3 divided by 4%. It's 82.3. Current market price is 82.5. Simple, guys. Yeah. Sure. Question number 7, guys. Let's start this question number 7. A minute's time for you to read the question. Just a minute's time to read the question. Please read the question in a minute. Okay. Have you read it? Now, capital structure of Sun Limited as on 31st March 2003 is as under. So equity share capital is 80 lakhs, 8% preference share capital is 40 lakhs, 12% debentures is 64 lakhs. Okay. And the reserves are 32 lakhs. Sun Limited earns a profit of 32 lakhs annually on an average before deduction of income tax, which works out to be 35% and interest on debentures. So Sun Limited is earning a profit of 32 lakhs annually. So we have this is but before deduction of income tax, which works out to be 35% and interest on debentures. So which profit is this? Is it profit before tax? Is it profit after tax? Or is it profit before interest and tax? What is this 32 lakhs as? Going by the statement, it is obviously earnings before interest and tax, right? So normal return on equity shares of a company similar placed is 9.6%. So on a similar company, the investors are getting 9.6%, but there are certain conditions. The condition is provided profit after tax covers fixed interest and fixed dividends at least 3 times. Capital gearing ratio is 0.75. Yield on share is calculated at 50% of profits distributed and 5% on undistributed profits. Okay. So profit before tax covers interest and fixed dividend at least 3 times. The normal return on equity shares of company placed is 9.6%, provided condition is profit before tax, PBT. It covers fixed interest and fixed dividends at least 3 times. Capital gearing ratio is 0.75. Yield on share is calculated at 50% of profits distributed and 5% on undistributed profits. Okay, so this is something, incremental thing. It's a different thing that we have here. Now, Sun Limited has been regularly paying equity dividend at 8%. So this company has been paying regularly dividend at 8%. So dividend, of course, it's going to be of the face value. Compute the value per equity share of the company, assuming 1% is the additional risk premium. This 1% is the additional risk premium which is applicable for the 1 time of difference. So if there is like a change in this capital, this cover for 1 time of difference for interest and fixed dividend coverage, and 2% for every 1 time of difference in capital gearing ratio. So if your capital gearing ratio is, instead of 0.75, if it is higher, of course the risk is higher. Equity shareholders are going to expect a higher rate of return by 2% for every 1 time of capital gearing ratio change. And same goes for this coverage also. Okay, so let's our first task is to calculate the profit after tax. So let's go ahead and calculate Just close it and open it again. Yeah. So calculation of profit after tax. Now we know that earnings before interest and tax is given as, how much is earnings before interest and tax? $32 lakhs, right? So 32 lakhs. Now from that, of course, we are going to reduce the debenture interest. So debenture interest is going to be how much, guys? Debentures are 64 lakhs. On 64 lakh, 12%. So we have like 64 lakh into 12%. So 7,68,000. So we have profit before tax as 32 lakh minus this. So that works out to be profit before tax. Now after PBT, we are going to reduce the tax also. Less. Now tax rate. What's the tax rate given to us? How much is the tax rate? Income tax is 35%, right? So it's going to be PBT multiplied by 0.35 is the tax rate. Then we have the profit after tax. Now profit after tax, it's PBT minus this. Now do we have preference dividend? Yes, there are preference shares were issued. So of course we need to reduce the preference dividend. So preference dividend will be 8% of preference dividend, 8% of 40 lakhs. So it is 40 lakh into 8%, which is 3,20,000. To be the difference between them. This is net profit for equity shareholders, right? But what is the amount of equity dividend that we are paying? Has the company declared any dividend? Yes, the company has been paying a dividend of 8%, right? So what is the amount of equity dividend? Less 8%, right? So that's going to be 80 lakh into 8%. So we are paying a dividend of 6,40,000. So what will be the profit? I mean, retained earnings, or the balance is, transferred to retained earnings. Yeah. Retained earnings is 6,20,800. Correct? To get the value of a share using a different approach in this question. Okay. So what we have in this question additionally is we have to first compute these numbers. Profit after tax cover for fixed interest and fixed dividend, right? And also capital gearing ratio. We need to get these numbers because based on that, we are going to decide what will be the discounting rate. So let's first calculate the interest and preference dividend coverage. Okay, interest and preference dividend coverage will be, of course, we'll say, sir, it is for preference dividend, we need to pay PAT, right? Plus, we will add the debenture interest, right? So PAT plus debenture interest, which will be, of course, debenture interest will be 1 minus T to give it a after tax effect. and then we divide it by debenture interest plus the preference dividend. Okay. So interest and preference dividend coverage is like we have PAT to pay the preference dividend, but obviously we would have subtracted interest here. So we need to add back that interest after tax effect and see whether we are able to pay the debenture interest or not. So PAT is 6,20,800. To that, we are going to add interest is 7,68,000. So interest is 7,68,000 into 1 minus 0.35. Right, and then we divide it by debenture interest of 7,68,000 and add to it the preference dividend. So preference dividend is 3,20,000. Okay, so this works out to be like 6,20,800 plus 7,68,000 into 0.65 divided by 7,68,000 plus 3,20,000. So this coverage ratio works out to be 1 point. One second. There is some problem, I think. 7,68,000. PAT is different. PAT में कुछ तो problem है. Oh, sorry. Yeah. PAT is, I've taken a wrong number. So PAT is 15,80,000. Yeah. So this is 1.91. Right. So this is 1.91 times. What was the standard that was set? Profit after tax should cover fixed interest and preference dividend at least 3 times. It should be covering it at least 3 times. Now, is the cover happening to be, 3 times? Is the cover 3 times in our case? The cover is less, right? It is 1.91 times. Correct? So it's going to be 1.91 times. Now, what is the here the term you need to understand? This particular term. At least 3 times. So if it is more than 3 times, then it works. If it is less than 3 times, then it's a problem. So we need to look at what will be the risk premium due to this coverage ratio of 1.91 times, right? So due to this risk premium, what will be the coverage due to the this aspect? So risk premium is something that will be applicable here, right? So it is going to be the risk premium. We say it should be, for 1% for every 1 time of difference between interest and fixed thing. So risk premium will be how much? What will be the risk premium due to the lower coverage? Coverage to be 3 times. We wanted the coverage to be 3 times, but it is 1.91 in our case. So if it is 1.91 in our case, what will be the risk premium that will be applicable? So like, where are we falling short of? Like 3 minus 1.91. But this needs to be multiplied with how much risk premium? 1% for every 1 time. So into 1%. So if I apply this over here, this into 1%. So how much will be the risk premium? It will the interest coverage ratio being not sufficient. Then the second thing is we also have to get the capital gearing ratio. So let's see what is the capital gearing ratio and also the risk premium for that. Capital gearing ratio. How do we get the capital gearing ratio, guys? Capital gearing ratio is funds which require fixed return upon funds which do not require fixed return. Right? So which are the funds that require fixed rate of return?
Sir, that is estimate around 4.8. Maybe it's the same like of TCs are pending at outside.
So capital gearing ratio. What will be the capital gearing ratio? Preference dividend plus debenture upon equity share capital plus the reserves. So the capital gearing ratio will work out to be preference dividend as how much? Sorry, not preference dividend. Why am I writing preference dividend? It will be preference share. So preference share will be 40 lakhs and debentures are 64 lakhs. So 40 plus 64 divided by equity share capital plus reserves, which will be 80 plus 32. So what's the capital gearing ratio? It is 84 divided by 112. Can I say it's 84? No, not 84. It's 104. Yeah, 104 by 112. So capital gearing ratio is again 0.93. Capital gearing ratio is 0.93. What was the benchmark of capital gearing ratio? It was 0.73. If your capital gearing ratio is higher, on that you require a risk premium of 2% for every one-time difference. So what will be the risk premium now? Risk premium due to higher capital gearing ratio. What will be the risk premium due to higher capital gearing ratio? We wanted a capital gearing ratio of 0.75, but right now it is 0.93. So 0.93 minus 0.75 multiplied by what is the risk premium that we want? 2%. So this will be 0.93 minus 0.75 multiplied by 2%. So risk premium will be 0.36%. So additionally, we want 0.36 as the risk premium. 50% of profits distributed and 5% of profits retained. Okay, so 50% of profits distributed. So what's the profits? What is the amount of profit that has been distributed? Of course, 6,40,000. 6,40,000 into 50%. So that will be 6,40,000 into 50%. 5% on retained earnings. So retained earnings is like 6,20,800 on that 5%. So we are assuming this 6,20,800 into 5%. So this is our total income. The total yield that we have, yield on equity shares, is totaling to this number. So just like dividend, we have the yield or income on equity shares to be considered as 3,51,040. Okay. Now this particular yield on equity shares, that we say 3,51,040. We are going to calculate the value of the share. Now there is no growth rate specified over here. Value of equity shares will be simply yield divided by required return. Okay. Now yield is something we know. What will be the required return here? What will be the required return? Required return will be, what was the benchmark return for similar companies? For similar companies, it was 9.6%. Correct? So for similar companies, it was 9.6%. So obviously we need the 9.6% rate, but in addition to that, we need this 1.09% and also we need this 0.36%. So what's the total return that we need from this, the shares? 9.6% plus 1.09 plus 0.36. So the return that we need from the equity shares is 11% or 11.05%. So value of equity shares will be, of course, 3,51,010 divided by 11.05%. That gives us a value, right? What is value of divided by, what was the number of equity shares we had? 80 lakh divided by 100. So this will be like 80 lakh divided by 100. This is the number of shares, which is 80,000. So we get the value of equity shares as 39.72. Okay, value of equity shares is 39.72. That's for this particular question. Okay, so it was a different approach question altogether, where we were supposed to calculate the yield on equity shares by taking some portion of the distributed profits and some portion of the retained profits. Okay. Are we good, everyone? Yes. Perfect. So you're free to ask the queries. Summarize this question. Okay. This question was simply to calculate the value of each equity shares, Savita. So, you know, the different approach was different. They were not asking us to calculate retained earnings as your income. And we just took the present value of it. Now, to take the present value, we need a discounting rate. Now, that discounting rate was, a benchmark return was given as 9.6%, to which we were supposed to add the risk premium. Now, those risk premium that we were adding was dependent on two ratios. One was the coverage ratio, interest and the preference dividend coverage ratio, and second was the capital gearing ratio. So we computed the interest and preference dividend coverage ratio to be 1.91. The question has 6% is the required, and same goes for capital gearing ratio. There 2% was the risk premium which was applicable. Okay. Now, using that the risk premium, we computed the required return. So we divided the required return with the yield, because this was supposed to be the cash flow for the value of this equity share. Yes.
Open has, anyone can speak.
Any queries, guys?
Student, the session has been opened for your queries. You can even have a talk with us, sir, also. Okay.
Okay.
Yeah. Okay, student. Now, in this last question, you have seen that we are making using different criteria. Now, if you recall that, Bandhu sir, if just correct me, I think there is one net operating income approach for the cost of capital, where with the increase in the debt, I think cost of equity start rising.
Correct.
Some consideration is also here.
Capital structure.
Capital structure, yeah. In capital structure, there are three operating income, net income approach.
Yeah, correct.
So I think to some extent it is also linked to that. And student, I think there is one doubt maybe come to your mind. In the final solution, the figure is coming around 39.727. Now, generally, it is a very common question. Sir, up to what decimal point, how much for how many decimal point we have to round off the figures? Okay. So it is very important to note that in this case, we have to see that if in the question some specific instruction has been given then you just follow the same. Otherwise, like for security valuation, normally up to 2 decimal point, the value is justified, because if we round it off, so the figure will come 39.73. Okay, student. So okay, now is the okay. So never go, so generally for the security, because security up to 3 decimal point, because generally these are quoted into up to 2 decimal point. Okay, student. Bandhuji, just display our mobile, our landline number and our email ID. Student, if you have any queries, you can send it to us. Okay, you just get it type if yeah.
Recording in
Enlightening the student
progress.
on this important topic. And student, thanks to you for patiently listening. See you in the next one. Thank you. Have a nice day.
Recording stopped.
Yes.
Yes.
Session over. Okay. Okay.